let's now get you a corporate conversation. Raymond reported an inline set of numbers in the fourth quarter. Revenue has beaten estimates led by the real estate business. EBITDA and profit after tax also came in line with street estimates. The company actually reported its highest ever annual and quarterly revenue and profitability in Q4. To discuss this, Vamakshi caught up with Amit Agarwal, Group CFO at Raymond. Listen.
Actually, if you see that we are quite satisfied with the performance overall, considering the health of the market situations. We all know that the retail has been quite weak in the last full year, and there was only a very short period around Diwali time when we saw a little uptick in the demand. Otherwise, the whole wedding demand and the general retail demand was a bit slower considering the retail inflationary pressures and the other factors which played heavily on the discretionary. And people have been a little bit on the other discretionary spend. However, in spite of that fact, if I look at my branded apparel business, which has been able to grow more than 20% year on year, that reflects clearly that the value of the brand and the kind of changes which we are bringing into the branded apparel business is very, very strong. The number one, if you see the retail expansion which we have done, over 200 new stores which we have opened, and plan to open another 350 to 400 stores over the next 2-3 years will help us support this business. Second thing is, in line with our expansion on the ethnics, which is we have today almost 115 stores, is also going to be a big growth driver in terms of our lifestyle business. The third piece is the garmenting business. The garmenting business, where we are putting capex of almost 200 crores, expanding the lines and increasing the capacity by 1/3, will take us to the third largest suit maker in the world, have also shown a good growth and a good profitability improvement, and this will help further to grow the revenues going forward. So as we have talked about earlier, that overall as a business, we are quite satisfied, though 7% in this year. If I look at the condition of the market, retail very, very weak, we feel that we have created a platform which will enable, as soon as the market gives you a little bit more positive hint, we should be able to grow significantly better than the market.
And now talking about the garmenting segment, because this is the only segment that has witnessed a degrowth in the fourth quarter, any specific geographies or clothing segments that is perhaps hurting the performance of the company in this particular segment? And as you pointed out, you're also enhancing capacity out here. So any concerns with regard to maybe having overcapacity or some cost drags?
Absolutely not. I think this is only relevant because of the Red Sea crisis, that the shipments could not have been taken, and shipments are taking longer than the usual normal time cycle. So, but we believe in the strong Make in India philosophy and the China+1 theme. I think that has enabled us. If I look at the history in the last 3 years, we have been always having an order book of more than 6 months in the garmenting business, and we continue to do so. Today also there is no significant change. And the best part is, as we have an integrated supply chain model, right from the yarn to the finished garment, we get the customers' confidence significantly higher. And therefore, we add every year, I think more than 12 to 15 customers. Every year we are adding, and it is a journey. So we clearly see that this investment is absolutely right, and you need to prepare these investments in order to participate in the growing of the market. And today, China+1 is helping all the Indian garment players in a very big manner. And we would become the third largest suit maker in the world in the next, after the capex is being put.
All right, and now moving on to your engineering business then. This has a revenue run rate of anywhere between 200 to 230 crores over the last couple of quarters. Now with the acquisition of Many Precision coming in, what will the new run rate be? And you know, there are obviously concerns around exports, given that nearly 60% of your FY23 pro forma basis revenue is derived from exports. Do you see any bit of concerns out here?
So look, the revenue post Miny acquisition could be in the range of 450 crores, 450, 475 crore per quarter. We are expecting 1800, 1900 crore revenues. That is what we have delivered. And going forward, there is a big growth driver, because there are 3 businesses in the engineering. One is an engineering consumable, which has some weakness in demand in the export market, especially in the Latin America and Africa. The other piece is the auto ancillaries business, which is the ring gears business and some of the other auto components, which we are seeing a significant growth. If I look at it across the geographies, we have become the #1 supplier in the ring gear segment. We enjoy almost 10% of the global capacity. And in India, we enjoy any market share with the domestic OEMs, anything ranging from 57, 58% to 68, 69%. So that is a great place to be in. Even in the export market, some of the larger players, the top OEMs, are just giving the contracts to us year after year. And the best part is, with the Maini acquisition, the top 15 global auto OEMs are our customers. And that enables us as a synergy. We believe the one customer which is known to Maini is not known to Ring Plus or not have been supplying should be able to get the benefit. So and the vice versa. And the third piece is the aerospace and defense components and EV components, which is again a very, very fast growing segment. And I think there we are expecting more than 20% plus year-on-year growth.
But there's another growth driver that we'd like to talk about, and that is the real estate business. When I look at the presentation, it says that you can generate incremental potential sales of almost 23,000 crores apart from the booking value that you've already received from your remaining Thane land as well as JDAs. So what do you expect out of this booking potential to actually come through in FY25?
So look, I would not like to make a guidance, so to speak, for 25. But I can give you the real estate, the way we have the 100-acre land and the total potential of this Thane land, which we own, is in the range of 25 to 30,000 crores. And we have signed 5,000 crore worth of GTS. So that put together, we believe over the next 3-4 years, the revenue run rate should be in the range more like 3,500 to 4,000 crore per year run rate. And that you can see demonstrably that in this year, the pre-sales booking, we have delivered 2,300 crores. So that clearly shows that as we continue to launch the projects and continuously develop.
That is Raymond for you. Need to get